Ahoy there, mateys. Welcome to the high seas of finance. Today, we're setting sail on a thrilling expedition to uncover the hidden treasures buried deep within the treacherous waters of financial statement notes. These notes, my friends, are not for the faint of heart. Think of financial statements like a pirate's treasure map. The main statements, the balance sheet, income statement, and cash flow statement, they're like the X that marks the spot. But the real loot, that's in the notes, the scribbled instructions and cryptic clues that tell you how to actually find the treasure. Now, some might say these notes are drier than a ship's biscuit left out in the Saharan sun, but I say hold your seahorses. With a little guidance, even the most landlubberly accountant can decipher these cryptic messages and unlock a treasure trove of financial insights. So grab your spyglasses and your thinking caps, because we're about to embark on a journey that will transform you from a financial first mate into a true captain of industry. Let's face it, nobody likes reading the fine print. It's tedious, it's boring, and it feels like a chore that never ends. It's like trying to understand the terms and conditions of a 50-page software license agreement. Your eyes glaze over, your brain melts. You start to wonder if it's even written in a language you understand. You start to question your own existence. Why am I doing this? Is this really necessary? But here's the thing. Ignoring financial statement notes is like setting sail without checking the weather forecast. You wouldn't do that, right? You'd want to know if a storm is brewing. Sure, you might have a smooth journey for a while. The sun is shining, the waters are calm, and everything seems perfect. But you're also increasing your chances of getting caught in a financial hurricane. One moment, you're cruising along, and the next, you're battling waves and wind. These notes are crammed with crucial information that can make or break your investment decisions. They are not just filler, they are the meat and potatoes of financial understanding. They tell you how a company recognizes revenue, whether it's facing any going concern issues. Translation, could they go bankrupt tomorrow? And the accounting policies they use to cook their books. Present their financial information. It's all about transparency and understanding what you're really getting into. Think of it like this. You're about to buy a used car. You wouldn't just take a quick glance and hand over your money, right? Would you just hand over your hard-earned doubloons based on a quick glance? No, you'd want to dig deeper. Or would you want to know if it had been in any accidents, how many miles were on the engine, and whether the previous owner used it to transport livestock? You'd want the full story. Spoiler alert, you want that last bit of information. Because that information can change everything. Financial statement notes are your Carfax report for companies. They give you the history, the details, and the context you need. They give you the inside scoop so you can make informed decisions. So next time, don't skip the notes. Dive in and get the full picture. Okay, let's dive into the deep end and talk about accounting policies and depreciation. Don't worry, I promise to make it as painless as possible. Accounting policies are basically the rules a company uses to record and report its financial information. Think of it like choosing between different navigation tools. Just like you might choose between a paper map, a compass, or a GPS when you're out exploring, companies have different methods to track their financial journey. Some companies might use a trusty old compass and sextant. That's like straight-line depreciation. Others might prefer a fancy GPS system. That's more like accelerated depreciation. Each method has its own advantages and can lead to different financial outcomes. Depreciation, on the other hand, is how companies account for the wear and tear on their assets over time. It's like acknowledging that things don't stay new forever. Imagine you buy a brand new pirate ship. Over time, the sails will fray, the masts might need replacing, and the hull will probably get a few barnacles. These are all signs of aging and usage. Depreciation is how you account for that decrease in value. It's a way to spread the cost of an asset over its useful life. Now, here's where things get interesting, or should I say, potentially alarming. Companies have some flexibility in how they choose to depreciate their assets. This flexibility can lead to very different financial statements, and those choices can have a big impact on their reported profits. It's a strategic decision that can influence how investors and stakeholders view the company's financial health. It's like choosing between two different routes on your treasure map. Each path has its own set of challenges and rewards. One might be shorter and easier, while the other is longer and more treacherous. The choice of path can affect how quickly you reach your goal and what you encounter along the way. Both will get you to the treasure eventually, but the journey and the amount of treasure you have left at the end will be very different. So understanding these policies and methods is crucial for navigating the financial seas. Next up on our financial statement, adventure inventory valuation methods. These methods might sound a bit dry, but trust me, they're crucial for understanding a company's financial health. Don't worry, I'll keep it brief. Relatively speaking, of course. We'll break it down so it's easy to digest. Inventory valuation is all about how companies determine the cost of the goods they haven't sold yet. Think of it as a snapshot of the value of all the items sitting on the shelves. It's like trying to figure out how much your treasure chest is worth before you've had a chance to count all the gold doubloons. Imagine the excitement and the challenge. There are a few different methods companies can use, but the most common are FIFO, first in, first out, and LIFO, last in, first out. Each method has its own logic and implications. FIFO assumes that the oldest inventory is sold first, while LIFO assumes the newest inventory is sold first. It's like a game of strategy. It's like choosing which cannonballs to fire first during a naval battle. Do you go with the tried and tested ones or the fresh new ones? Do you use the ones that have been sitting in the hold the longest, FIFO, or the ones you just loaded, LIFO? Each choice can lead to different outcomes. The method a company chooses can have a big impact on its reported profits, especially during periods of inflation. This can affect everything from taxes to stock prices. So, it's important to understand which method they're using and why. This knowledge can give you a clearer picture of a company's financial situation. Otherwise, you might end up walking the plank when it comes to making investment decisions. And nobody wants to be caught off guard in the financial seas. Section 5. Intangible assets and other mysteries of the balance sheet. Now let's set sail for the mysterious island of intangible assets. These are assets that don't have a physical form, like patents, trademarks, and goodwill. They're like the legendary fountain of youth. You can't touch them, but they can be incredibly valuable. The problem is, valuing intangible assets can be about as easy as teaching a parrot to sing opera. It's subjective, it's complex, and it can have a big impact on a company's reported financial performance. For example, goodwill is the premium a company pays to acquire another company above and beyond its net assets. Basically, it's the "we're really excited about this acquisition and we're willing to overpay" fee. But goodwill can evaporate faster than a raindrop in the desert if the acquisition doesn't work out as planned. So it's important to understand how a company values its intangible assets and whether those valuations are realistic. Section 6. Management discretion and other shenanigans. Avast there, mateys. It's time to talk about one of the biggest dangers in the world of financial reporting: management discretion. You see, even with all the rules and regulations, management still has a surprising amount of leeway in how they present their company's financial performance. It's like they're the ones drawing the treasure map, and they might not always be interested in making it easy for you to find the X. They can choose which accounting policies to use, how to value their assets, and what information to disclose or not disclose in the notes. And sometimes, they might be tempted to bend the rules a little or a lot to make their company look better than it actually is. That's why it's so important to be a skeptical reader of financial statements. Don't just take everything at face value. Dig deeper, ask questions, and be on the lookout for any red flags that might indicate management is trying to pull the wool over your eyes. Section 7. The jargon jungle. Navigating the language of notes. Let's face it, financial statement notes can be about as easy to understand as a drunken sailor speaking in tongues. They're full of technical jargon, complex sentences, and enough acronyms to make your head spin. It's enough to make even the most seasoned investor want to toss their computer overboard and set sail for a deserted island. But don't despair. There are ways to navigate the jargon jungle and come out on the other side with your sanity intact. First, don't be afraid to ask for help. There are plenty of resources available, both online and offline, that can help you decipher the language of finance. Second, take it slow and focus on one section at a time. You don't have to understand everything at once. And third, remember that practice makes perfect, or at least it makes things a lot less painful. The more you read financial statements, the more comfortable you'll become with the language. Section 8. The power of financial literacy. Knowledge is profit. We've covered a lot of ground today, from the importance of reading financial statement notes to the dangers of management discretion and the jargon jungle. But here's the bottom line. Understanding financial statements is like having a superpower in the world of investing. When you can read and understand financial statements, you're no longer at the mercy of Wall Street analysts, financial gurus, or shady characters in back alleys. You can make your own informed decisions about where to invest your money, and you're less likely to get taken advantage of. Financial literacy is about taking control of your financial future. It's about having the confidence to make smart decisions with your money, whether you're investing in the stock market, buying a house, or just trying to figure out how to make ends meet. Section 9. Conclusion. Go forth and conquer those financial statements. So there you have it, me hearties. A crash course in the wild and wacky world of financial statement notes. I know it might seem overwhelming at first, but trust me, the more you practice, the easier it will become. Remember, these notes aren't just some boring accounting requirement. They're treasure maps to financial success. They're your secret weapon in the battle against financial illiteracy. So go forth and conquer those financial statements. And who knows, with a little luck and a lot of hard work, you might just find yourself sitting on a treasure chest of your own.